So let's talk about tax amortization benefit. Again, as we talked before, the tax amortization benefit is the benefit that the acquirer will receive from being able to amortize the intangibles that were acquired in the acquisition. In order to be able to amortize those intangibles, an acquirer has to acquire a target in the asset acquisition, or it has to acquire the target as a stock acquisition, but make so-called 338 election. So if any of those apply, then the tax amortization benefit should be included. In this case, it was a stock acquisition without 338 election, and therefore there is no tax amortization benefit. But either way, we're going to go down here and we're going to look at it. The tax amortization benefit here, there is a formula that calculates it, and as you can see, the formula is pretty extensive. 15 years is something that's standard. It's part of the Internal Revenue Code a requirement for the amortization of intangible assets, regardless of whether it's goodwill or any kind of intangible. It takes 15 years to amortize it. It has to be amortized, and it's always 15 years for anything that's not tangible that was acquired. It's only US, it's very different in different countries. Discount rate is typically used as IRR, and so we have that calculated, or we will have that calculated. US statutory tax rate is commonly assumed to be at 40%. Now the important part is to really come up with the value, how much intangible are we going to amortize, because that's obviously important. So the intangible amount essentially is calculated as the purchase consideration less tangible assets. And so when we double click on this to see where this 39887 number comes from, we get to this side of the page. You will see that it's kind of here on the side from the main client presentation. This is not seen by the client, but you can see that we have $44 million in cash was paid for the acquisition. The total tangible assets that were acquired in this acquisition were $4 million, and so that what that leaves us is with $39.887 million in intangible value, or in excess consideration in this case. And so it's this intangible amount that was paid for that's being amortized for tax purposes. It's very important not to confuse that with the total consideration, and it's important to make sure that we subtract those tangible assets. As you can see in this calculation, you do not have to do adjusted net working capital here. That's already incorporated in the $44 million value, so that should be removed. And so also to take a look at where this 4113 number comes from, tangible assets, that's as you can see, the fixed assets that were acquired that we subtracting from there. The again, the net working capital, because it is being used in the valuation, is effectively those current assets and current liabilities are effectively taken into consideration in this cash flows, and so as well as the net working capital adjustment. So therefore we do not have to make an adjustment here for it. Again, this number 6481 is calculated based on that formula. However, this number here in yellow has to be calculated very accurately. That should be the focus of this calculation.